This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to LGIM Talks and another episode of Fixed Income in Focus, the programme where we chat with members of LGIM's active fixed income team about the key drivers of bond markets, the technical aspects of fixed income, what's front of mind and what's on the financial horizon. My guest today is Colin Reedie, Head of Active Strategies, which comprises both active fixed income and active equities. Colin has been at LGIM since 2005, and prior to that, he's held roles at Henderson Global Investors, Scottish Widows and Scottish Amicable. And I'm delighted to say he joins me from across the table. And Colin, good morning to you. How are you?
Good morning, Francis. I'm very well, thank you. Very well. Thank you for having me.
No, well, thank you for coming on to the programme. Now, here we are at the halfway stage, hence the title, Halfway There. Just paint the macroeconomic picture for us, if you could, Colin. It seems to me there are an awful lot of drivers of markets at the moment. Maybe you just outline some of them for us.
Indeed, many powerful forces at play, we think, and mighty is the debate going on currently to try and identify where we are in terms of the stage of the economic and the business cycle. This year so far, with carryover strength in the US economy, has had the debate focused on whether this is a sort of late cycle acceleration, driven by the forces that have made the post-pandemic world so interesting and challenging to navigate, or it is actually the beginning of the next cycle. We have soft landed, and we're on the cusp of, some form of AI-driven investment boom that will prove to be completely agnostic to the level of interest rates. So risky assets can continue to sort of carry on up. But the problem is, depending on which side of that coin you choose to land, both possibilities have got profoundly different asset allocation implications. There's a lot of focus internally on trying to pin this down.
Is that quite unusual, Colin, to not really know where we are in a cycle? And is this proving really problematic for your asset allocation decisions?
No two cycles are ever the same. I think that's probably worth getting out of the way straight up front. But, history, we tend to look back in order to try and, ascertain where we might be heading in the future. But, this cycle has been so distorted by what we've talked about in the past, that sort of seismic shift from monetary policy to fiscal policy and the sheer sums of money that Western governments in particular have deployed. Initially, they were morally obligated to do so in the pandemic, but we've obviously seen them carry on spending, which gives us a lot of confidence that the baton has been firmly passed from monetary to fiscal. And that really has shored up economies and made them much, much more, robust in the face of what was a very dramatic increase in interest rates by anyone's standards. That sort of continued strength in the US in particular has it was the most widely forecast recession.
Yes, absolutely.
By
yes,
the economic
yes,
community ever,
yeah.
and everyone was wrong. So yes, lots of I can sense quite a bit of head scratching in markets going on at the moment.
And that brings me quite nicely onto my second point, really, because hindsight's a wonderful thing, isn't it? But here we are in June. Equity markets have done incredibly well, and that's despite the fact that bond yields have, I think, a couple of times knocked at the 5% door. Again, would you have expected that?
No, I think if you rewind the clock back, that wasn't what people were expecting at all. I think if you deconstruct the more recent move higher in yields, what the drivers have been, and the fact that earlier in the year it played out against the backdrop of lower volatility in bond markets, would seem to suggest to us that that was investors getting more comfortable with the concept of higher yields and economies' ability to weather those higher yields. Going back to my earlier point about the drivers possibly being as the agnostic to the level of interest rates. Now, that can't last forever, but it's clearly lasted longer than most were expecting.
I think it was this time last week. You were giving a breakfast chat, weren't you? And I was taking notes furiously. And you put up a chart, which I thought was a really interesting chart of a reference to total yield, because of course that's, I suppose, the only way you can look at it, with credit spreads being still pretty tight. And you said, quite interestingly, that seems to be okay with investors for now, but when might it not be okay?
Yeah, it depends what you're buying and why you're buying it, and are you the right investor? Are you taking the decision that is appropriate for your client's money effectively? When we look at the charts, this one is data going back over the last sort of 20 years, yields and credit spreads effectively. And if you deconstruct those and look at them separately, it's really interesting because investors usually receive twice the compensation for credit risk at this level of yield. So because we've moved into a new interest rate regime, all-in yields look very, very attractive, north of the 80th percentile, as I say, over the last 20 years. But spreads are in the sort of bottom decile, given how tight they are. Now, how many current owners and buyers of credit are simply ignoring the spread and just focusing on the yield? It's almost like, well, let's not worry about that. Look at the all-in sticker price here. It's so attractive. Now, if there are, pure credit investors who should be sensitive to the excess return aspect, if they're buying all-in yields just because of the size of the number, then we might be sowing the seeds for a problem a little bit later. If the US economy continued to cool, or if that cooling sped up, then risky assets would probably come under a bit of pressure, equities and credit, investment grade credit, and that spread on its own offers very little protection at these levels.
So again, then, I mean, you mentioned the US. Is it all US driven?
No, you can look, I mean, it's all different, but the stats I was using was effectively US corporate credit. But if you look at EM, if you look at other regions, it's a similar kind of dynamic, maybe not quite as pronounced as what we see in the US, but certainly similar charts are produced. In spread terms, one part of the investment grade market that looks not too bad is in the euro area. On that sort of spread decile measure, there's a little bit more value there, but even still, it's pretty consistent. You've referenced so many powerful forces at play and a lot at stake. Valuations are tight, yields are high, equities are high. There's not a lot of room for maneuver or protection if something unexpected happens, if something goes wrong. And when you get that kind of dynamic, then markets tend to move in a reasonably correlated fashion.
Okay, now you mentioned something going wrong, and I think up until now it's fair to say that you've not been able to see a real catalyst for a sell-off. But where we have seen some volatility, not necessarily in Europe either, and I'm thinking India, I'm thinking Mexico, is around elections. And of course, it is a huge period for elections. We've got, we've just had, haven't we, the EU elections, UK elections in July, and of course, the biggies in November with the US. Obviously, we don't want to get into the political weeds, Colin, but talk us through, again, the sort of asset allocation decisions around this volatility around elections. And you mentioned that all-important shift from monetary to fiscal policy. Where do we go from here? I mean, fiscal policy wins votes, right?
It does. It's politically popular. We saw that during the pandemic. Writing blank checks to your electorate was pro-growth, quite popular. And, that's one of the reasons why we think politicians in particular will be reluctant to go back. It's very hard. I think the market was pretty primed for election risk this year. This was well flagged as we came into 2024, just the sheer number or percentage of the global population that would be going to the polls at some point this year. They're very binary outcomes in most cases, tough to predict, and you still do get surprises. Not least the initial exit poll steer in India suggesting a very powerful display for the incumbent Modi. And then as the votes came in, it was almost had to be slammed into reverse gear, and a very different
Yeah, quite
political landscape
extraordinary.
for him
Yeah.
as he enters a remarkable third term. We were also worried about a drift to the right in Europe. This is not new news. We've obviously had Geert Wilders, the hard right firebrand, who won a lot of the votes in national elections in November in Holland. So this is something that markets have had on their radar for a while. I think the surprise with the EU elections was the bold and probably quite high risk strategy of President Macron to announce a snap election. And certainly yesterday we did see weakness in French government bonds and French corporate bonds. Spreads were wider noticeably there, as that obviously introduces yet more uncertainty. But for all the drama that we saw, in Germany and in France, there were projections of an even bigger shift to the hard right coming into those, which probably weren't materialized. So it's another step in the direction of travel that markets were reasonably well priced for. Go back to your point about lack of catalysts. We've had to insert the French one now, which wasn't part of the calendar at the beginning of the year. But I sense most people are wanting to remain pretty constructive on risk, credit risk, long risk in their portfolios over summer. And then they'll start to have a think about the US presidential election from sort of September onwards as we build up to that date. It's very tough to price this.
Yeah, no, sure. I sense that. But if we had to put you on the spot, Colin, I mean, what areas would you favour at the moment going forward into the second half, and what are the areas you just don't like?
In terms of favouring in an expensive market, there are pockets of value, we think, in emerging markets, particularly if you have the risk budget to take emerging market high yield exposure. We certainly prefer that relative to pure corporate high yield exposure on a relative value basis. We, like a lot of people, so this isn't an earth-shattering view, like the front end of spread markets, where, as I say, yields are still high and spreads on top of that aren't too bad. If you believe that central banks will be proven right and they seem very keen to cut rates. The ECB have obviously kicked us off and started on the rate cut path. I sense central banks are keen to follow through generally. Lots of focus on the Fed for obvious reasons. If that's the case, then high quality credit at the front end of markets, short duration, is offering you decent yields without the duration risk of owning longer bonds, which may be vulnerable to curve shifts if indeed we have soft landed and we are at the beginning of a next cycle. We think there'll need to be a debate about term premia and what's the long run average rate, as it were. That might need to be rethought, and if so, that would put pressure on longer yields and the curve. So that works for us. Default predictions are very, very low. Companies are doing generally pretty well, and many global cycle indicators are strengthening. There's a myopic focus on the US economy, which we understand. But if you sort of broaden your perspective, China's had a reasonable Q1, improved growth expectations there. Looking at some of the surveys, growth momentum seems to be rising in Europe and Japan as well. So, as the US slows, other parts of the global community are strengthening, which might keep global growth in a relatively reasonable period, which case investors will probably remain relatively relaxed.
Okay, that's interesting, isn't it? And just on your point on duration, Colin, from that, do we conclude then that you are shorter than the benchmark on your duration?
Yeah, we've got sort of reasonable cross-market views in place as well. But longer term, we are in the camp that, we've talked about politics, but we think irrespective of whether Trump or Biden is in the White House, this bias towards fiscal policy will remain. That's a much more inflationary backdrop. It's a much more growth stimulating environment as well. And that probably keeps pressure on yields. The labor market is in the US is, depending which way you look at it, you could argue it's cooling for choice, but not by much.
No.
There doesn't seem to be any widespread concern or shedding of labor by companies.
So you're hugging that shorter end, because why wouldn't you with those yields, really?
Yes, and if we think there's the risks of a nastier move further down the curve, then we'll wait and see. I mean, that will offer up opportunities as and when it happens, but you want to be shielded from it if it's a key concern of yours.
Okay, well, we're coming to the final question. Is there one other thing that I haven't mentioned that you'd like to?
I think we continue to always forward looking and trying to sort of ascertain what the next stage of the cycle might look like. What will be the general dynamics of it, because as I mentioned earlier, no two cycles are the same, but they can share historical sort of similarities. And one thesis that came up last year actually was a more sort of 1970s stagflation environment, and that was discussed in markets and dismissed largely because of the uber bullish potential impact of AI. Risky assets like equities chose to take the more optimistic road. But if you look at the sort of the main features, most importantly, inflation came in sort of three separate waves back in the 70s, and they were all related to sort of geopolitical events. So, we had proxy wars in Southeast Asia, Vietnam. We had several wars and revolutions in the Middle East. There was an oil embargo, an energy crisis, shipping disruptions. There was increases in deficit spending, rising interest payments for both governments, corporates and consumers. That has more than a palpable whiff of similarity to today. Three active conflict zones: Eastern Europe, Middle East, and the South China Sea, which we need to keep an eye on as well. And obviously, there's been lots of coverage of deficits at concerning levels and continuing to grow with this focus on fiscal. So I think we think that kind of backdrop is worth exploring in a little bit more detail, just to try and get a clearer picture of what second half of this year might look like, but more importantly 25 and further out.
Yeah, because of course those who haven't lived through a stagflationary period, you're talking sticky inflation and cooling off growth, aren't you?
Well, it's also, I think it's very easy to underestimate the power of the feedback loop that we got from the peace dividend. From the sort of 80s onwards, post the 70s, improved geopolitical stability, translated to the opening up of command economies, that in turn sort of increased, global trade. We traded more with each other across goods, services, and commodities, and also resulted in declining inflation and interest rates as a result. So there was some really powerful sort of tailwinds that came from this, that it's easy to miss from that peace dividend. And unfortunately, what we're looking at now is a peace dividend that's morphed into a rights issue effectively.
So we're looking at the reverse, basically.
Well, and does it reverse it? Which bits do reverse? Yeah. It won't be a carbon copy, as I say, but I think that slightly longer term perspective is useful here, because going back to how we started this, there are so many big pieces and powerful forces at play here that I think you need to be much more open-minded to possibilities that you may have dismissed in previous cycles as just being so improbable that you can dismiss them out of hand. So we continue to operate around the prepare, don't predict motto. And any high conviction views that get expressed, as part of our natural debate and investment process, get extremely well challenged, because how can you have a super high conviction view here when so much is going on and so much has taken place that if you're honest with yourself, if you try to predict this 5 years ago, you would have been laughed at probably.
Okay, well, I'm sure we won't be laughed at, but the watchwords are open-mindedness and be nimble. So on that note, Colin, thank you so much for your time today and all your nimble views. Good to see you as always, and we shall be producing a next Fixed Income in Focus in a couple of months' time as part of our really regular service. So for now, Colin, thank you, and thank you to all our listeners.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.